Do you believe your portfolio is set and forget? But that's not the case. Welcome to Money Gainers Hub, the channel where smart money moves become simple. We break down personal finance wisdom, including earning, saving, wealth building, and investing into powerful and practical tips. So, you can make smarter money moves fast. Grab your notebook, get focused, and let's unlock your next financial breakthrough starting right now. So, in this video, I am going to explain the investment method called ETF rebalancing. Rebalancing is essential for maintaining a healthy ETF portfolio aligned with your goals and optimizing your long-term returns. Why is rebalancing important? As time passes, your portfolio may drift out of balance. This occurs when certain ETFs perform better than others, increasing risk in unexpected areas. Rebalancing realigns your investments with your initial strategy. It is not about chasing returns, it's about staying focused and safeguarding your wealth. Understanding rebalancing. Rebalancing involves adjusting your portfolio to maintain its target asset allocation. For instance, suppose your desired allocation is from 60% domestic, 30% international, 10% bonds. If domestic ETFs perform exceptionally well, they may comprise 75% of your portfolio. Rebalancing means selling some domestic ETFs and purchasing more bonds or international ETFs to achieve your 60-30-10 target. How often do most investors rebalance? Once or twice annually, or when allocations deviate 5 to 10% from target? However, rebalancing too frequently could incur unnecessary fees or taxes. Conversely, rebalancing too infrequently may expose you to unintended risk. So, what is the straightforward approach? Review your portfolio every 6 months and adjust it only if necessary. How to rebalance your ETF portfolio step by step. Follow this simple 5-step process. Step number 1. Assess your current allocation using a brokerage dashboard or a free app like Empower. Step number 2. Measure it against your target allocation, such as 60-30-10, domestic stocks, international ETFs, or bonds. Step number 3. Identify both overperforming and underperforming ETFs which are overweight. Step number 4. Sell the ETFs that are overweight and take profits from those that grew too fast. Step number 5. Purchase underweight ETFs and reinvest those funds into ETFs below their target. Pro tip: instead of selling to correct the imbalance, consider using new money to avoid tax implications. What are the tools available for rebalancing? You are not required to do everything manually. Numerous platforms provide tools to assist, such as option number 1, Fidelity and Vanguard, excellent portfolio analysis tools. Option number 2, M1 Finance, enables automatic rebalancing with a single click. Option number 3, Morningstar Portfolio Manager, monitors drift and performance. Apps like Empower also alert you when it's time to rebalance. Awareness of taxes and fees is important, especially when rebalancing taxable accounts. So pay attention to areas like Area number 1, capital gains tax. Selling ETF shares at a profit may incur this type of taxes. Area number 2, transaction fees, because some brokers might still charge small commissions. To minimize these costs, rebalance in tax-advantaged accounts like IRAs whenever possible. Or utilize dividends or new deposits instead of selling whenever feasible. When to avoid rebalancing. Avoid rebalancing solely due to market fluctuations because that reflects emotional decision-making. Moreover, skip rebalancing if the drift is minimal, within 2 to 3%, or if your portfolio still aligns with your goals. So maintain a disciplined, scheduled approach and avoid guesswork. Hence, rebalancing is one of the most overlooked habits for wealth building. It helps manage risk, secures profits, and maintains alignment with long-term investments. Begin reviewing your portfolio every 6 months. Make minor adjustments when necessary and automate where possible. If this video was helpful, please hit like, subscribe, and check out our next video.